name is Emily Hayes, and we are going to be talking to you today about real estate investing. I am a real estate agent. I've been in the industry about 8 years. We're just purchasing our 6th investment property, and I have Ashlee Shipley here, who is an amazing lender that I work with, and she can tell you a little bit about her experience.
Hi, like she said, Ashlee Shipley with Veritas Lending. I lend mostly in Utah, but also Texas, North Carolina, and Arizona. And Emily and I have had a passion for creating wealth through real estate and helping others do the same. So we hope this class brings some value to you today.
So the big question is, why invest in real estate? So if you're watching this video, I'm assuming you already have some of these answers. But the number one thing is building wealth. So one of the ways that you can build wealth is through leveraging your money. So one of the best ways you can leverage your money is through real estate. What we have noticed in our portfolios is we're getting higher returns than what if we put the same amount of money that we put in our down payment into the stock market. And those returns are continuing to grow year over year. So that has been one of the biggest benefits in investing in real estate.
It's also a scarce resource. So there's even a song about it, right? By Dirt.
Yeah.
So people need a place to live. It is a safer, more secure investment, in our opinion at least, and something that will help us secure not only monthly returns, hopefully, but then that equity growth can also be tapped into to leverage again for another property. And here in Utah, I mean, our population growth is huge. We're expected, 1.3% every year?
Yeah, year over year.
Mm-hmm. So, and we're landlocked in mountains. So eventually these properties are not going to be available. They are limited.
We have an interesting topography here. She said landlocked between 2 mountain ranges, and just like the other challenging areas like San Francisco and Seattle, those also have those same type of issues. And so you've seen values rise dramatically in those areas, and we do see long-term with projected population growth for that to create a similar situation here in Utah.
So how do we make money off of an investment property? There's 4 main things. I'll go over 2, and then Emily will cover the other 2. So you take out a loan, right? So you're leveraging a down payment, which is typically 20 to 25% on an investment property, unless you get creative, but let's say 25%. But then you get to control an asset that's much larger. Then every month you have somebody paying that mortgage, and part of your mortgage is the principal portion. That principal portion is going to go down each month. It's kind of like a forced savings account, right? So your loan amount goes down, but it's not your money. It's OPM, other people's money. Next, while your loan is getting paid down, the home is also hopefully going up in value, and that's called equity growth. So the difference between what you owe and what it's worth is equity that you can tap into and go leverage for additional properties, business purchases, commercial real estate. I mean, that's just straight up money that you can access with home equity lines of credit, through cash out refinances, etc. And both of those are phenomenal. In addition to that, you also have
depreciation. So if you've ever heard about the tax loopholes for real estate, it's a real thing. So a lot of people will purchase real estate to get the tax benefits. So when you own a home or an investment property, you actually can depreciate it, the asset. So it takes the land value, and then there's the value of the actual home. So you can depreciate that over 27 and a half years. And what that does is offset any of the income that you have in. So essentially you're not really paying any taxes on the income that you're getting from the property. So it is a big deduction that actually adds to your year over year returns. Now, when you sell the property, you have to recapture that. So you do eventually have to pay taxes. However, there are different avenues you can take by, we'll talk about this a little bit later, but called a 1031 exchange, where you move an investment property that you sell into another investment property that's of the same value or higher. And then you don't have to pay the taxes, and you can defer those down the road.
And that rental income's fantastic. That's the whole reason we do this.
The rental income.
Number one reason.
Yeah, rental income is huge.
Hopefully that cash on cash. And talk to your CPA for sure, because you can do the depreciation over the 27 and a half years, or you can do cost segregation. CPA can walk you through that, but that's just an accelerated program to take advantage of the depreciation a little bit quicker.
So if you have a high tax liability, like investing in real estate can actually offset some of your ordinary income depending on how you structure your business around your investments. And that's another thing a CPA can help you organize.
We know some good ones.
We can refer some good ones. So what to look for in an investment property? We talked a little bit about this. So equity growth potential. So is this an area that has equity growth potential? Now, if you look at Utah, and with the population growth and projected increase in housing demand, this is what we call an equity state. I personally am buying property in Utah for the appreciation. That's what I see the value in. There are other states which are more of cash flow states. So cash flow would be maybe an asset that might be worth $200,000 and you're getting $600-$700 a month return on that investment. But in 10 years, it might be worth $215,000. So it's just dependent, and that's something we can talk through. Utah is a equity growth area. There are other areas of the country that are more cash flow. And depending on what your situation is, whether you're looking to pull out money, for having steady income for retirement, then that might be a better option for you.
Your write-offs and things like that. So again, talk to either of us, talk to a trusted loan advisor, see what matches for you and your goals. But for sure, consider these 4 things. So first and foremost, location. Just because a home is cheap does not mean that it's going to cash flow, and it does not mean that it'll appreciate. You're not going to get in the weeds with evictions and things like that. So location's huge. That ties into the economic development. So when you're looking at a potential home, look at how the economy is doing around it. So Utah's extremely strong.
Yeah. And very diverse as well in the different types of sectors that we have here. So we're not dependent on one, like energy or, manufacturing specifically.
There are places that do that, but for the most part, Salt Lake's extremely diverse. And when you're looking at the home, you've got your big ticket items. So you want to look at projected repairs. How's your roof? How's your water heater? Has it had water damage? Is it older than dirt and probably has corroded piping that you're going to have to deal with? Or do you go new build?
And we have gone the route of buying new construction townhomes because they fit right into that range of where most people are spending on rents. So we're getting a lot more people that can actually afford them. And we don't have to fix yards. We know our fixed expenses. So that's been my risk tolerance with my partner. And that's the way we've gone. So it's just one strategy, but not every strategy is for everybody.
And this is why we work well together, because I'm different. I'm in multiple states. I have single family homes, and I tend to go single family over something with an HOA and then have someone manage it. So, and there's reasons behind both, and I think it's the deal in front of you as well, the house in front of you. If someone came to me and said, here's an amazing townhome, I'd probably do it. And then last but not least, the 4th thing to consider when you're looking at it is the rentability. So would you live there? Is it in a safe area that's going to command a good solid rent, or are you going to have it listed for a while and kind of begging for someone to take it?
Yeah. Looking at like schools,
sex offender lists.
Yeah.
And walkability, is it close to transportation, things that you wouldn't think about. They need to be on your forefront when you're buying investments versus primary residences.
So what are the 3 types of investment properties? The first one, as Ashlee had mentioned, single family homes. Single family homes are really great. The value is determined by the market. And when I say single family, this includes townhomes, condos. These are single dwelling units.
One family lives there.
When you go to sell a single family unit, investors can purchase them and owner occupied, and usually the value is determined by the market demand. So I personally like these because I think the equity growth potential can be higher than some of the other categories that we're going to go over.
Your bucket of buyers is bigger.
Yeah, your bucket of buyers is bigger.
And then you've got the multifamily, which is what everyone pushes, but is not always your best bet depending on where you want to buy, and that's multifamily. So you've got one structure that has multiple living units inside. That's 2, 3, 4 units if you're talking residential, and then anything over 5, pops us into commercial. So even if it's an apartment unit with 5 houses, that's still a commercial deal. But then you also have commercial, like commercial buildings that you would lease out to a business versus a person. And the lending is a little bit different as well.
So how to purchase an investment property? So you can purchase it with partners. I have several clients that are doing this where they're partnering together to purchase multiple homes together, just to kind of, I say, leverage their money a little bit better and have a little bit more diversity in their risk. You can take out a HELOC, so a home equity line of credit, or do a cash out refi to get the down payment money. A lot of people do that to, again, leverage their money into other assets that are going to be producing higher returns. And then
personal favorite.
This is her personal favorite and mine as well. So I'll have you talk through that.
House hacking. So you're going to live in your primary residence, put 3 to 5% down to get in, live there for a year to whatever it may take, and then peace out and do it again. So that year that you're living there, you're going to save up that money again to go buy another 5%. As long as you're improving your living situation, you're going to get approved for those loans. So instead of 25% down, now we're talking leveraging 5% down. Also, a primary residence is going to have a substantial better rate than a rental unit. So not only is it less money down, but the payment is likely lower. And this is somewhere you're going to live, so it might be a nicer place. I don't know, maybe. But you can even do this with duplex, triplex, and fourplex and live in one of the units and have the other offset. And you've probably heard that before. Again, you need to look at your state. Utah hasn't been making duplexes and triplexes for years. So unless you want to live in something from 1920, maybe we could do something else. But you could start in a condo and a year later go to a townhome and a year later go to a bigger townhome, then a single family, then a larger single family with a mother-in-law apartment. And all of those would be 3 to 5% down. And at the end of 10 years, you could own, 5 to 10 properties and you're done. Your retirement's set.
Yeah, that's it. The retirement is set. So once you have those homes paid off, you've just got a massive amount of equity and cash that you save that you can retire early, which I imagine is the dream for most people.
Get your time back.
Yes. So let's talk through single family versus multifamily. So the pros of single family would be there's larger market window time to sell. The value is dependent on the market. The cons is it's more vulnerable if the home is not rented out for periods of time. So with a multifamily, you have, let's say, a fourplex, you've got 3 other families in the unit. So you have one unit that's not rented. That's going to be less of a risk for you. It's less likely to improve rents with incremental improvements. So there's a lot of opportunity in multifamily to, put in new paint, carpet, just upgrade it, and you can raise the rents a lot higher in those units typically. And then if there are higher price rentals, your rental pool is going to be smaller. So it depends on the area in Utah, but if you're above the median price of home in your area, a lot of times those people will typically tend to buy homes rather than rent. And so the rental periods are shorter. You're filling the gaps a lot more. So that's just one thing to consider. In multifamily homes, they're harder to find, as Ashlee noted.
In some states.
In some states. In Utah specifically, they just don't build a lot. Older multifamilies can have a lot of deferred maintenance. So if someone's owned a property for 30 years, it's possible they haven't put in the money to update the electrical and the plumbing because they haven't needed to. You can only market them to investors, and then the rates can be higher than single family, even for investors.
Okay, so let's talk about the purchasing investment property types, okay? So we've touched on this, but let's touch on the loan types just a little bit more. So you're purchasing as an investor. Your absolute minimum down payment for standard Freddie Fannie financing is going to be 15% down. However, the best pricing, terms, things like that typically come with 25% down. So the downside of that is that's a lot more money out of pocket. Keep in mind, it's still 25% to control 100% of the asset. So it's still a great deal, but it is more expensive. And then your rate's going to be 0.5% to 1% to 1.5%, just really depending on the market. And then when you go to get your cash out, you're going to need to do a refinance. a cash out refinance or a HELOC, which is subject to the market at the time as well. And then my favorite, we'll do house hacking again. And so this again, there's tax benefits as well. So let's say that you bought in 2020, you have a ton of equity. Mm-hmm. You either you go get a home equity line of credit and then move, or even if you sold that, as long as you have lived in that home for 2 of the last 5 years, you have a tax write-off that's up to $250,000 for a single person or $500,000 for couples. So that is access to all of that equity. And then you can go buy another primary home, buy an investment home, and maybe even buy a vacation property or a second home. So a second home needs to be a distance from your primary residence. It needs to make sense. So in Utah, it'd be like Salt Lake and then having a condo in Park City. So you can purchase it with about 10% down, and the rate is going to be similar to a primary residence, but still higher and lower than an investment. The downside here is you're going to have to qualify for the whole payment. So a primary residence and a secondary home, you're qualifying for the entire thing with your income. When you purchase as an investor, 75% of the market rent is used as income. So you're qualifying for 25% of the loan. It's much easier. This is why people can do it. That second home can be used as a short-term rental, but you've got to use and live in the house for at least 2 weeks out of the year. So an Airbnb would be a good option for this, and then you just have to use it. You can't rent it out all the time. And then you can still deduct the taxes on interest, just like you would on an investment home. And this could be a good reason to have a vacation, right?
Yeah.
So Airbnb, I do have one. I'm happy to help if you have questions on how to set it up. And I've got connections that have 80, 100. So they can go over and I can help with the costs and things like that. But on an Airbnb, usually that 10% down is going to turn into more money out of pocket for furnishings and things like that. But they do tend to make 2 to 5 times more than a long-term single-family rental.
2 to 5 times cash flow.
So, excuse me.
But yeah, it definitely depends on the area that you're in. But yeah, Airbnbs can have a higher cash flow. So that's why a lot of people are moving that direction. But
you have to know what you're doing.
Yeah. So let's talk about return, that leverage piece. So we talked about the 25% down that you need to have for an investment property. Let's just say, for example, you had 3% down because you're buying it as an owner occupant. So you're renting out your house you already bought, you're buying another house. So you got another 3%. You really only put 3% down. So being that it's the same, the cost is $450 for both homes, 3% down, 25% down. Your down payment is going to be about $13,500 on the 3% and $118,000 on the 25%. That's the biggest barrier to entry is that down payment. And that's why I love that regular people can actually buy multiple properties and own a real estate empire with so little down. So it's a really great way for just anybody can do this. Closing costs are going to be about $6,000. That very first year, your equity growth is going to be about the same at $18,000. But since you put so little down on the 3%, your actually first year cash on cash return is 125%. So you're making 125% on that very first year on your initial your initial investment of about $19,500. On the 25% down, you're getting about a 20% cash on cash return with the average of a 4% annual increase, which is just a historical average. Sometimes it's higher, occasionally it's lower. So you're looking at 125% versus 20%. Now, 20% is an amazing return when you look at the stock market, right? Yeah. There's a lot more, I would say, steady incremental growth in the real estate market, although the last 2 years have been a little extraordinary in that field. But I love real estate just because the volatility, as you see in the stock market, is just not there.
It's not as extreme.
It's not as extreme, yeah.
All right. I know it sounds like I'm beating a dead horse, but I really love house hacking this much. So I want to break down 5 years of house hacking, okay? So if you're starting out and you have a decent job, you've got a little bit of money set aside, or your parents are willing to gift it, whatever. Let's say that you want to buy a condo. $250,000 is the purchase price, and it's your first purchase, so you can buy it with 3% down. which is $7,500 as a down payment plus closing costs, whatever. Year 2, that condo is now going to be a rental property, and you're going to do 3% down again on house number 2. Most people can do this because there's a loan program that will allow you to have another property and still do 3% down as long as your income is within a certain limit. It's called Home Ready if you're in another state and need to look at that. So now we have a rental property and we have house number 2. And let's say house number 2 is $350,000. So that 3% down is going to be $10,500. That can come from your savings, equity in house number 1, your retirement. Talk to your CPA, but there's ways to get money out of your retirement without implication. Gifts, side hustles. We just need that funds. So now you live there another year. Now it's year 3. Property 1 and 2 are rental properties. And property 3, we're going to buy with 5% down. So $450,000 purchase price, 5% down, bada bing, bada boom. Year 5. So the reason I skipped 2 years is we got a little bit bigger, right? So now we're going to go for like your house. So year 5, we're going to turn rental number 3 into a rental property and purchase your dream home. Let's say $600,000, and it's going to have a basement apartment. We're going to do 5% down on this one, which is $30,000, which we could grab from house 1, 2, or 3. Checking, savings, retirement, gift, lots of areas for that. You're going to rent out the basement, and that will pay at least the interest portion of your mortgage. It should at least. So your cost of living is near nothing because you're making cash on the first 3 properties and on this basement rental. And then you have this beautiful property upstairs that you're living in. And now let's fast forward.
So in 30 years, okay, this is my exciting. In 30 years, with an average appreciation of 4%, you will have paid off assets of about $5,351,000. So that's the asset value based on a 4% annual increase of all your homes that have been paid off. The rents that will bring in is going to be about $14,000 a month if you're renting out your basement still. And then that's all with an initial investment of about $81,500. 61,000 plus 20,
even
$20K in closing costs, but yeah, it's like 80. You can take $80,000 and make that into $5 million
5.3
35 years.
No big deal. Now let's say you started when you're 20. These suckers are paid off by the time you're 55. That is 12 years faster than the retirement age. And you do all that work in the beginning, and that $600,000 house, you just stay put. You don't do another thing. You don't enter in the other investments. Mm-hmm. You just house hacked and you're done. You have 4 properties. Boom. An average person, it's estimated, needs $3 million in retirement each. So you married, hubby and wife. You're basically there. And then those other properties are bringing in cash flow. So that's the other portion. Yeah. You live off of that plus your retirement. Bada bing, bada boom.
So we love talking about this because most people just don't see the vision or don't really understand how this works. I personally did not when I was in my young 20s. I wish I had. But this is something that could change so many lives. So please talk to us about this. We would love to kind of help you get set up and get started on the house hacking journey.
So I'm going to grab Airbnb because I do have one. So the setup was harder than all of the things. I did so much research of what sheets, what coffee maker, who's going to manage it, who's going to be the handyman on duty, things that you don't think about that's going to provide value, like chargers and sound machines in all of the rooms. But once it was set up and started functioning, holy cow, it did so much better than my long-term rentals. It was almost frustrating. I'm like, dang it, now I got to do this again. That worked. But the big things here is, you can get into something like this with 10% down, and you can use your property still. So mine's in good old Logan, Utah, and we go up all the time. It's so fun. But you do need to qualify for it. So you need 2 years of income. You need to be able to qualify for your primary residence and this home. You will not get credit for rental income. There are debt service loans that will give you credit to go buy a second home, but you're going to have a bigger down payment. it loses some of its pizzazz if you go that route, but everyone has a case-by-case basis. We'll just determine what the best one is for you. The startup costs are high, so it may be a lower barrier to entry as far as 10%, but you don't want to put crap furniture in there that's just going to break. You're going to deal with a lot more issues, and there's so much that you don't think about. Like, you need 3 sets of sheets per bed, you need extra tables, chairs, like plants, everything. And then if you have management run it, I personally run it on my own, but management costs are higher because there's so much more hands-on. So I personally do it. It's probably, I don't know, maybe an hour a week max. So it's not horrendous, but that's the only one that I manage. I would never manage my long terms. So there's definitely some pros and cons, and they do work. You just really have to know where you're buying and be ready for the additional cost after the purchase.
Yeah. And there are some cities that are pretty strict about, they don't allow Airbnbs. From my understanding, Utah has a law that says that cities can't sit there and troll the internet and come after you. But if you have a neighbor that has a noise complaint and your city doesn't actually legally allow it, you could be shut down. So that's just something to be aware of, so we can do the research city by city. There are some cities that will give you licenses, some cities that just don't
do it legally.
monitor it all.
Oh my gosh, guys,
but
do it
yeah,
legally.
That's exactly. So if you're already an investor and you are looking to, let's say, leverage your money again, so let's say you gained, $200,000 in equity over the last several years, you want to now split that and buy something to have even more real estate. You can do that through what's called a 1031 exchange. So it's a tricky process. You need to have an expert who specializes in 1031 exchanges. The government is going to make sure that your I's are dotted and your T's are crossed, or you will not be able to do this. So I can get you in touch with an expert in that field. How it works is when you sell your home, you have to identify a new property within 45 days. So that's the tricky part, is you have very limited time to identify those 2 properties or however many properties you're going to purchase during that time. And then you have to close within 180 days. Now, if you're watching this 3 years from when this was actually posted, laws change. So I'm going to say consult with your CPA. That's the one thing I can say, but there is an option to kind of defer the taxes.
And this is so you don't pay capital gains. So if you sell investment homes rather than primaries, you're going to pay capital gains taxes within a certain bracket, and they can be hefty. And the whole point of all the real estate things is to avoid taxes. So don't just sell and be like, oh, I'll just take the hit on the $75K I'm going to have to pay on this. Yeah. Don't. There's ways around it. You just need to partner up with someone who has done it and can put you in touch with the correct people, which we can. Yeah. So let's talk deals in this market, Miss M. So we're Utah. We are, what is this month? October 2022 right now. And it's a little crazy out there.
Yeah. So I actually did a survey the other day on LinkedIn, and I asked, is it a good time to buy a house? And 83% of people said no. So I'm like, I have a lot of education to do. So we have seen a little bit of a dip in the market, and this is very timely based on today's market. So we've seen a decrease of about 10, sometimes 15% from the peak of the market, especially with new construction. That's where we saw the biggest run up, and that's where we've seen the biggest settling in prices. There is so much opportunity because buyers for the first time in years actually have are in the driver's seat, which is never happened in my career in 8 years. So what is happening now is we can actually negotiate. So we can negotiate price, we can negotiate repairs, we can negotiate to have closing costs covered, to help buy down the rates, which rates are really the biggest challenge right now. So with an investment, it's a little bit different. There's not as much flexibility. So if you're buying it to do the house hacking thing, I think this is actually the perfect time to take your current property that's fixed into that 3% rate, buy your next property, utilize some of the programs to buy down your rate, which can get you 2% lower on your interest rate and make it more affordable, and then get into that dream home or your next level up home, and then have that initial property that has the lower mortgage payment. So you're going to start making some cash flow off of that and getting into your next place. So that's what I'm teaching people right now to do. Don't be afraid. Everyone is afraid. And when everyone else is afraid, you got to jump in, because that's when the money is made. When everybody else gets comfortable and the demand has not gone away. It's still here. So when everybody else starts to feel more confident and maybe rates trickle down a little bit, you're going to see like everyone's going to jump into the market. So it's going to be pretty intense, and you don't want to be in a situation where you're battling it out with another buyer and you're paying higher prices for a home when you could have during this time of year, October, November, December, gotten something for less with less competition.
And I want to speak to the lending part of this. So if you can afford something right now, go buy something right now. It's all on sale. And they're still appraising. It's not like you're buying for $400,000 and then we're getting an appraisal at $350,000. We're still appraising and getting $425,000, $430,000. They're on sale. Mm-hmm. And you have to be able to afford the payment. In 2008, back when, things were ugly, it's because lending was ugly. You had to have a pulse. You could just tell the lender what you made. That's like mind-blowing. That is not a thing. So even with the 2-1 buy downs, meaning your interest rate's 2% lower for the first year, 1% lower for the second, you have to qualify at the highest rate. So a lot of people are priced out right now. If you can get into something, you are so lucky. And I would never miss an opportunity like this. The buyer's markets last for the shortest amount of time. I would go into it thinking 5 years. Can I live here for 5 years? Can I afford this for 5 years? Do I have some money left over in the bank? Do I have an ABCD option plan? Can you rent out a room? Do you have a basement rental? And this isn't something you walk into, but to protect yourself, we want to make sure you're in a good spot. But holy cow, I would avoid the bloodbath that is likely coming because these interest rates will come back down, and just refinance at that point.
So then you've locked into a lower price, and then you refinance into a lower interest rate. And now you've got a really good payment that you can then rent that place out and buy your next place and house that into your third level home. So this is something you want to be telling your friends. Do not be scared of the market right now. Just it's not like people are.
Even the housing in 2008, it came back around fairly quickly.
Yeah.
It's 5 years or less on the last 4 declines. That just means 5 years. You gotta last 5 years if something horrible happens. But I think that that's also something that people in Utah do. We kind of like set down some deep roots.
Yeah.
We're not a transient state.
So can you purchase a home with a basement apartment and turn it into a top and bottom rental unit and make your own duplex? Ashlee, what's the answer to that?
Legally, no. So laws are changing because housing is in a crisis mode and there's not enough affordable housing for people. So I think that this, again, depending on when you're watching this, but right now, no. Right now, that is not legal anywhere. The legality is you have to live in the top and typically have family live in the bottom. And you still want to tell the state and do all of the things. But you know what? People do it. We're just not going to tell you to do it.
People do it, and you can make your own decisions. So how do you make buying an investment property easier? One of the biggest barriers for my husband when I was trying to convince him to buy a home was, I don't want to manage it. I don't want to call in the middle of the night. So I was like, no worries, we'll hire a property manager. So property managers typically charge between 7 and 10% of the rents every month, and then they'll charge about 30 to 50% of the first month's rent to get a tenant in there. And it's 1,000% worth it.
1 million. Like 2 billion.
It's very much a passive. I would say the only active part of the investment is that we have to pay the mortgage every month. But essentially, it's very passive because we have somebody actively managing it. The other aspect of that is I don't get my emotions involved in it. So I don't have a personal relationship with my tenant. And so if they're late, it's a business. It's a business. It's treated just like a business. So I will raise rents when it's appropriate. I do everything based on what with my property manager recommends, and they run it like a business.
Well, and the property manager, that is their job. So they have handymen, painters, contractors on speed dial because they know that they're going to have to tap into that. They know what a good tenant looks like. They can look between 2 applications without emotions and really analyze that, and then you just say, good, sounds good, and move on. I would not do it without. What if you had to do an eviction on your very first round because you were like, it's not worth 10%? Oh my gosh, guys. Especially on those first couple, I would property manage those all day, every day, just to make sure that you're protecting yourself.
you do, the expense is something to consider, but when you really look at how much equity you're getting and what you're really, like, the value that you're getting out of your home, oh my gosh, it's just, like, it's been so worth it. And it's given us the capability to continue to buy rental properties and not feel overwhelmed. So a few things to consider when you are purchasing investment properties. You always want to have an umbrella policy to protect your investments and your personal assets. Talk to your insurance agent and let them know what you're doing, and make sure that you have a liability umbrella policy that covers you in case there is any lawsuits or anything happens, that you're personally covered. That is number one. Always have enough savings to cover your incidentals. So if you have done an inspection on your property and the roof is needs to be replaced next year, make sure you have enough funds that you can cover that replacement of the roof. There are certain costs that just are associated with owning property. How long does carpet last? How long is paint going to last? You have to set aside money each year, kind of factor that in as a expense that you're going to have on your property.
How much would you say per house?
I do like about
3 months.
Oh, as far as, I do have savings for like 3 months of if someone just stopped paying their rent altogether. I want to have a buffer there. I know in the lending part, they do require...
it depends on how many properties you have. 3 is the minimum, but then you get up into, the 7th, 8th, 9th property, and you have to have 6% of your unpaid principal balance of all finance properties, except for your primary and the one you're buying.
Okay.
So this can come from other things, though. So like the home equity lines of credit are fabulous to have for incidentals because it's money that you can access like this, but you're not paying anything on it either. So one of my tenants covered the return in the house, and it knocked out an AC that was only 5 years old, and that was a lovely $7,000 incidental. But there's a home equity line of credit tied to that property, so I just pulled it, and the rent profit is paying that back. So the house and the renter are still paying it. So I love that. True reserves would be like retirement account, savings, life insurance policies with cash values, things like that. And those are kind of good to have. Those have bit some people in the behind for not having enough. So while I don't absolutely love retirement accounts, it's a personal opinion. I can talk to you about that offline. They are really good in this case. And something that you can use to get more houses.
So, and one thing I have to stress as you're watching this is you're probably also listening to podcasts and trying to absorb as much information as you can on the subject. Everybody has their own rental rules and what they will and won't buy. You've got to find your own. You got to figure out what works for you. I had someone give me a piece of advice when I started. I sold my property in Sandy because it was only going to cash flow like $200 a month. Well, that was dumb. He's like, only buy things that cash flow $600 a month. Well, that was when the market just went straight up. We ended up selling it to put it in other investment properties, but during that time, things started picking up, and now if we had kept that property, it would have been a better financial
I think that's the only regret any real estate investor ever has is when they sell a property.
Yeah.
There's still one that I look back on that was in West Valley, and I was like, oh,
why did I
no.
So don't, there's so many opinions out there. Talk to people, get advice, talk to us, but in the end of the day, it's all going to be a matter of running the numbers. Does it make sense? Right now, if we can get just something that breaks even, I'm thrilled. I have some that are negative cash flow. That's not something she would do. That's something I would do. We have some that are cash flowing that kind of balance that out, but we're looking for the best deal of what we think is going to eventually appreciate, and we're looking towards building our wealth and retirement that way. So that's me. Not everybody's going to be that way, and other people have other rules that work for them.
Most people think I'm crazy for buying in other states.
Yeah, but that's
buying on duplex in Pocatello in 3 hours.
So. And I think at the end of this, just the one thing I can tell you is it's a scary prospect because it feels scary every time I buy a house.
And this is number 9 for me, and it's still I think I did the numbers right. I'm pretty sure I know what I'm doing. So the scared never goes away. You just find your brave. I tell that to my 4-year-old. Find your brave. Find your brave.
And then also looking at the opportunity, the lost opportunity. So if you end up, walking away from something. So I have a story. I almost walked away from a home during COVID because I had put down about $10,000 new construction, $318,000 in American Fork. I ended up moving through with it because I had put $10,000 on the line, but I almost backed out. Within 2 years, that place is worth like $450,000. Now that's a little bit extraordinary circumstances, so I'm not gonna. But if I had walked away because of fear, then I would have lost out on that opportunity, and it's been a really, really solid rental for us. So, I do think following your gut is an important thing. If you feel bad about, like, if you don't feel good about moving forward with something, but just run the numbers. We can talk through the scenarios and really help you make an educated, informed financial decision for your future to meet your future goals. So we are here to advise people on, building wealth through real estate. We're doing it ourselves. We want to teach other people to do it, and that's why we're doing this video. So we are going to ask you to reach out to us to like and subscribe this YouTube channel.
We'll do better. Maybe not once every 2 years?
Yes, every 2 years. So keep adding.
We do a ton of classes in person, so we just have to get them online.
Please, note in the comments if you want us to keep you updated on future investor classes that we're going to be having in person and virtually. We are very big in education, so that's a very important thing for me.
And we don't charge.
No, it's free.
just say.
And we got our numbers down there too, so feel free to reach out. Call us anytime. So
Call, email, text. Yeah, whatever works. Thank you so much. See you.